when you put in the reps over and over again, you continually learn, you get better, and it just starts compounding faster. And it applies in so many different areas of life.
All right, y'all, welcome back to the Real Money Talk. So today, again, you guys know one of my favorite sections of what we do on Real Money Talk is get into Real Money Talk with people who have actually done it. Real people making real money, teaching you how to do the same thing. So today's Spotlight member did not stumble into success. He engineered it one decision at a time. This is Tom Rowan. He has built companies. He's taken one to the Inc. 5000 list 3 times. He's learned firsthand what works, what breaks, and when you scale fast. But the most important part is that it wasn't just all in business. He decided to change the way that he actually invested, and now he's having impact on other investors as well. So, after a massive return on a small residential property, Tom realized something that most investors won't admit. High returns don't always mean high quality of life. So I know that resonates with so many of the people that are tuned into this. So he walked away from a high return residential real estate model and went searching for something better. Now, that led him into the triple net lease commercial properties, predictable income, fewer headaches, and long-term stability. Does that sound good to anybody? So today he manages over $100 million in commercial assets. He's partnering with national brands that most people are going to recognize, but few of us know how to actually invest alongside these giants. So along the way, just while he was doing everything else, Tom applied his mindset to being an endurance athlete, patience, discipline, playing the long game. All of these things that he's used in both his personal athletic life and in his business, he has used to help investors step out of Wall Street volatility and into real cash flow assets. So, we're going to break down his thinking, his shifts, his principles, what got him here, and why they matter if you're serious about building wealth that lasts. Tom, welcome to Real Money Talk. We are so glad to have you here.
Yeah, thanks, Erica. Glad to be here and excited to dive into it today.
Oh, me too. I know, obviously, you and I have connected and spoken on a few different occasions, but when I was reading through everything that we sent, I was like, I didn't realize your background and everything that you had really done. I had just scraped the surface of it. So this is going to be incredible. This is great. So I'm really glad to have you on. So let's back a little bit up. Obviously, you've accomplished a lot. So you've scaled businesses, you've broken world records, and now you have over $100 million in commercial real estate. I think it's difficult for people to sometimes realize how those chapters connect. So, what do you think all of the lessons that you've learned from scaling your businesses in real estate and your athletic performance, what do you think um, all of those have in common that have helped you guide where you are today?
Yeah, I think, looking back, I'm always setting the goals and looking forward and, going to achieve that next goal. And sometimes we got to slow down, be present in the moment, but then also look back at, how far we've come and how we got to where we are. And I think if I was going to narrow that down to a couple key things, the biggest was self-discipline,
Mm.
consistency, and taking action.
Oh,
And so a lot of times it's easy to sit on the sidelines and to have like that what if and you kind of hesitant or whatever the case is. But what I've always found is like taking action and getting in the game.
hmm.
And then like once you start that, then it's just like having that self-discipline to be consistent. And when you put in the reps over and over again, you continually learn, you get better, and it just starts compounding faster. And it applies in so many different areas of life, whether I'm training for a 100-mile race through the mountains,
It's crazy to
or
me.
building a real estate portfolio. It's like, why didn't you just wake up one day and we had $100 million in real estate? But I knew if like I consistently took the actions to, look for opportunities um, to get one property at a time, all of a sudden, they start adding up, they start compounding, it starts snowballing bigger. And the same goes for running a 100-mile race. People are like, well, how do
Ugh.
you run 100 miles? And I'm like, well, 1 mile at a time.
1 mile
And
a day for 100 days, if you ask me, but I think you did it a little bit differently.
yeah, but it was consistently, putting in the work and
Oh my gosh.
starting off with 1 mile and then 5 miles and you build up to it. And so I think it's really just getting in the game and taking action, um, and just being consistent over a period of time, and it's all gonna, compound for you.
So what I'm hearing you say is that you have to continually put in the work. There's no magic pill that's going to solve whatever, whether it's business or personal. Yeah. Oh my gosh. Well, and you nailed it right on the head. It's so interesting that I think most people, especially people that are wanting to build wealth and are investing, we all have this mindset of growth, right? And I think all of us have at least been exposed to the simple principles of get in the game and be consistent. And obviously, like you said, be disciplined. And as simple as that sounds, it's powerful. And it's simple, but it's not easy, right? It's something that it's a decision that you're making every day, even when you don't feel like it. So that's just wow. Um, so let's go all the way back to 2011. You had a small residential property, a fourplex, if I remember correctly. You had a massive return, and yet you decided to walk away from residential. So obviously that's a completely controversial like idea that a lot of people would see and be like, oh my gosh, why did you do that? Can you walk us through why? Like what was the process and what led you to decide to take a different route?
So the massive return, um, I'll say it was a combination of luck and, you know, everything aligning for that. But it was an absolute nightmare
Mm.
to do that. So it was our very first property. I knew, from reading books and talking to people, and I knew to build up wealth, we had to get in the game of real estate. At the time, I was in my 20s. I didn't have any money. And I'd gotten an inheritance check from my grandpa when he passed away, and it was something like $5,300. It was a very small amount,
Let's be
and
real, guys. When he says inheritance check, he just said 5,300. This isn't like 5
yeah,
million. Because I know some
so,
people hear inheritance and they're like, oh, yeah, so that was easy. So
no,
I'm glad you clarified because that was going to be one of my questions.
he was a farmer, and lifelong farmer, and there's a lot of grandchildren and grandchildren and everything else, and so my share of it was right around $5,000. But in my 20s, that is what I had, and there was this fourplex that came available, and it was for sale right around 100,000,
Yeah.
and it was a fourplex, and then behind it was some storage units, and they were going to do seller financing, and I only needed to put 5% down. I had the money to put down, so we did it.
Wow. So they're
Um,
like, skies open, the angels sang, and then
yes, it was
shone
like,
the
here we
light
are.
right on this beautiful property. Wow. Okay, go
And
ahead.
then and then I realized it was not a beautiful property. It was in the most crime-ridden area of
Oh.
town. Our tenants, one was a drug dealer, one was a hoarder. The other, let's just say she paid rent in dollar bills. It was a mess. We were getting calls from police.
Oh.
You name it, everything bad possibly that could have happened with this property happened. Like if you had like terrible landlord stories for 20 years, that happened to us all in 1 year.
Oh my
And
gosh.
so absolute nightmare. And I was like, man, this is not what I signed up for. This is not the passive income that I was expecting or that I read about in books. Like this was the opposite.
Yeah, you're like, isn't
So
this supposed to be easy? Like, aren't I supposed to just be a millionaire and like go sip mimosas on the beach? Like this sucks.
yeah, it was more than a job. It was a headache. It was a
Oh,
nightmare. It was terrible. So what we ended up doing was we evicted all the tenants. And I was like, all right, we've got to get rid of the tenants first. We got rid of the tenants. We went to Lowe's. We got the cheapest possible carpet. We redid the bathrooms, the kitchens, painted everything floor to ceiling. When we cleaned it out, the last part of the nightmare was when we cleaned it out, it took us like 8 dumpsters full of all the crap that they were hoarding and left behind to get
I've
out.
watched
It
that
was
show Hoarders, and I don't think that 8 dump trucks is an exaggeration. Like those people, it is like floor to ceiling of stuff or their treasures, as they
Oh,
call
it was crazy. And then
it. Ugh.
hundreds of pizza boxes and just you name it.
Ugh.
And so we got lucky and we were able to sell the fourplex for $105,000. So we made a little money over top of what we paid for it, but now we still own the storage garages behind it.
Oh.
And so basically, we had those now free and clear. And we held on to those for a couple more years. And then we ended up selling those around 100,000. And that's where we made this massive return on this property. And so I think looking back, we bought it maybe right. We bought it right. We did a good thing by fixing it up and improving the property, and hopefully the new landlord got some better tenants in there. But it was also the aha moment, the shift of this is not the asset class we want to be in. About that same time, I'd watched the movie The Founder about
Mm.
McDonald's. And that's where I learned about triple net lease, commercial real estate, and being a business owner. I was like, you know what? Commercial is where we got to go because I can talk the same language as other business owners, and I like, just that camaraderie and stuff like that. And I understood it a lot better. So that's where it completely shifted our focus into commercial real estate, but then even more so triple net lease because while still operating as CEO of 1-800 T-shirts, I don't have the time to
Hmm.
put in, and I didn't have the time to deal with these headaches and phone calls and all this other stuff. And with
The
triple net
tenants and
lease,
toilet situation, right? Like every time a light
yeah,
bulb goes out, like golly.
yeah, with triple net lease, the tenant is in charge of all their maintenance, paying the property taxes, paying the insurance, everything. So it's very hands off. I mean, we don't even have keys to most of these buildings, and a lot of these properties we don't have to go to. So that was, kind of the asset class that we had to pivot into because of this.
Yeah. Okay. So I love that. You took first of all in your 20s took some money and applied it to what you knew you should do, which is real estate. And what's interesting, I think so many people are or were in your situation. I did that, right? Like my first house that I bought many, many moons ago was in 2008, and it was I bought it to live in it, but it was an absolute dump, not livable. I think a lot of people have heard this story. And so when you talk about movies, I didn't see this movie until later. It's an 80s movie with Tom Hanks called Money Pit. So that was my life for a little while. Like every time I fixed something, something else broke on this house, and anyway, cycled me down. And I lived in it for a little while. Then I rented it, and anyway, ended up making some good money on it. But to your point, we have like this negative experience with a certain segment of the market, certain segment of the industry. But it kind of had that triggering moment where I'm like, wait a minute, if I'm this young and I'm this dumb and I can still make money on it, like what if we actually apply a good system to this real estate model? So I think my point is so many people are in that position of like getting frustrated, making a little bit of money, but it's not worth their time. You took that mentality of wanting that passive income with the returns that real estate can offer and found triple net lease to be the check or the to be the thing that checked off everything you needed on your list to fulfill both your goal for income, but not so much on the time and the stress.
Yeah, definitely.
So with that, let's talk about this triple net lease. Um, it's been called the holy grail of passive income. So in plain language, explain what makes triple net leases different. I know a lot of people are familiar with residential versus commercial real estate, but getting into an even more specific sector of commercial real estate, what makes triple net different?
So it's really the lease structure and the types of tenants that are in there.
Mm,
So majority of, when I look at triple net lease, it's typically national tenants. The leases are structured so they're long term, could
nice.
be 10 to 25 years. And the tenant is responsible for everything in the lease. So in the lease, it says, all right, here's what the landlord's responsible for, here's what the tenant is responsible for. And all these are structured a little bit different, but we focus on the ones where the tenant is responsible for 100% of everything.
Wow.
They take care of the maintenance. If there's a toilet that needs fixed, the tenant takes care of it. There's trash, the tenant takes care of it. If there's light bulbs out or something, the tenant takes care of literally everything. The grass, the snow, everything on the property is the tenant's responsibility, including paying the insurance and the property taxes. And those are two expenses that on residential or even multifamily, as insurance and um, property taxes increase, that decreases your bottom line in how much you're making. So we wanted something that was very simple and very predictable, where we knew, okay, here's the lease with Starbucks. We know they're going to be paying $10,000 a month in rent. We know our payment to the bank is 7,000 a month. And that means we're collecting 3,000 in profit no matter what. We don't have to worry about
Wow.
any other variables or expenses in there because in the lease it says we're not in charge of any of those. So we're not worried about property tax going up. We're not worried about insurance because the tenant is paying that. We know every month for the next 10 years, we're going to be collecting the $10,000. We're going to be paying the bank seven, and we're going to get that 3,000 in property to either pay ourselves or pay our investors.
That's huge. And I can tell you right now, I'm in several multifamily deals as a passive investor, none of which are cash flowing right now. And the two that were cash flowing initially stopped because taxes and insurance spiked. So now this is, of course, most people that are in Texas know what a nightmare that's become. But I think taxes and insurance nationally always plays a role in any real estate scenario, and the taxes and insurance, those two properties that were cash flowing, are still not paying out any distributions because we're trying to recap and get caught back up because it's been such a nightmare. So to build that in and essentially mitigate that risk completely, oh my gosh, like what a I mean that is passive income. Wow, I love it. So excuse me, I'll have Jules edit that part out. So when we, like I mentioned, there's commercial real estate and there's residential real estate. So many people get started on the residential side, realize what a headache it is, but they're afraid of moving over to the commercial because they feel like it means more money, more risk. Obviously, you've played on both sides of the fence. Why has your experience shown to be the opposite, that commercial is less risky than residential?
It's just more predictable. I always use the term of, would you rather worry about getting paid by Starbucks on the first of every month or getting paid by the barista?
Yeah.
Right? Like
Mm,
they're a credit-backed company. I can count on that ACH coming into the bank account every month, right on the first. And we're not trying to chase down rent payments. And we also look at the overall, lifestyle freedom side of the business. And it's return on time, return on hassle, return on headache,
oh yeah.
return on stress. These are very low stress, assets to hold. There are also, um, legacy type properties. So a lot of properties that we're buying, we're buying these through families that have been passed down for generation upon generation. Just because once you get them and they're in the most prime location in your city, and you've got a tenant like Starbucks or Taco Bell or Arby's or Applebee's or something that's been there for 20 or 30 years already, like the chances are they're going to be there for another 20 or 30 years or
Yep.
beyond that. Just because they've got an established customer base, they've got good management, they've got established, workforce and stuff like that. And it's part of that surrounding communities, like their weekly or daily, it's like, all right, every morning I go and I get my coffee or I do this. And so I think the predictability and just that, being always in the need,
Hmm.
is just comfortable and knowing like you've got these big tenants and these long-term leases. It's just secure and predictable.
Yeah, and the amount of time, effort, energy, money, resources that these massive companies put into finding a new location, they've already done so much of their own research. Like you said, we were talking about McDonald's earlier. I know, like on the car dealership side, well, that doesn't really go into the food, but I'm just saying massive industries in general are doing a ton of research on where they're doing their next location before they ever actually pull the trigger. So once they're there, they've already done the research to make sure that it's going to work. And then when that model proves itself, why would they put in all that extra effort to move elsewhere, right? Unless it just flat out doesn't work, but that's what the pre-work is for. So yeah, they're vetting it even more than you are as the landlord. So I love that. So, what it sounds like is as an operator on the triple net lease, it removes a lot of the stress. It removes a lot of the unknown variables that really, I mean, let's be honest, over the last 5 years, the unknown variables have been oozing through the cracks and causing so many problems in deals that should have been good, operators that have been around for, decades. So, when we talk about the triple net deal, what does an investor not have to worry about in a well-structured triple net deal that you have seen cause problems other than taxes and insurance, obviously? But what do they not have to worry about with triple net that you see investors struggling with in other types of commercial deals?
I think having a locked-in rate as well.
Mm.
So a lot of our, lenders like to finance on these deals because they know they're backed by a credit rated tenant. They know the strength of these tenants as well. So we can get financing locked in for 5, 7, or 10 years.
Wow.
And just knowing that, especially that's the other variable that has gone up and switched a lot
Oh,
over, the past couple of years. Um, and so, if you look at multifamily that was purchased in 2021 or 2022,
oh yeah.
variable rate loans, that stuck a lot of people out, with where, the rates went up and sucked up all their cash flow.
Oh yeah.
Whereas, the Starbucks we bought in 2021, we got a 10-year locked in rate at 3.1%.
Oh
And
my
so
God.
I don't have to, we're at 3.1% until 2031. So we've got another 5 years locked in at that rate.
Holy
And,
crap.
so that's just like a huge advantage that we have over any other asset class. And even right now, I don't know because I'm not in the multifamily or the single family home space, but I believe rates, if you were to buy a house, a rental house today, or even an apartment, are rates somewhere around 7%, I believe.
Yeah, they're gonna fall in that seven range. And then I know business loans are still in the 8 to 9.
Okay. So,
So I'm trying to think of on the residential side. I would say on the residential side, rates for houses are probably going to fall in like 5 to 6. Again, I haven't bought a house in residential side in a long time, but they're going to be in that range. Regardless, 3% for 10 years is unheard of. That's incredible.
yeah. So right now, just put in perspective where we're at right now. I just got a quote yesterday from two different lenders for we've got two properties we're looking at, a Dollar General and a Village Inn. And the rate quotes I got were 5.5% and 5.75%.
Wow.
So our borrowing power is far better, than these other asset classes right now as well too. So we're getting a bigger spread on the cap rate to the borrowing rate, which in turn gives us a higher cash on cash return.
That's huge. I mean, it's a higher cash on cash return without the lingering concerns of the variability of those different factors, right? Like to be able to capitalize on both is wow, I didn't realize all of that. Um, okay, so we're talking about this from a higher level. I think, if I remember correctly, you guys are now opening up these opportunities of these triple net leases. Like you said, we've talked about all of the pros and the wins and the lack of variability with the ability to get higher returns. So you guys just opened a fund. Do we want to talk about that a little bit and how you're opening this up to other investors?
Yeah, so what I found out was a lot of people they want to get in on this asset class, but they don't know how to find the properties. If you drive down the street, you're not going to see a for sale sign in front of Starbucks ever. It's kind of this, what I would call underground asset class that nobody really knows a whole lot of information about. And so we've started a fund where, we're going to be acquiring between 20 or 30 properties and having a nice diversified portfolio of these triple net lease properties. And investors can, invest alongside of us and be part of the fund that owns these properties and get all the benefits of the cash flow with quarterly distributions, the tax benefits through depreciation,
Wow.
and the upside when we go to sell these properties and they raise in value over time.
Okay, so that was going to be one of my questions is obviously real estate, one of the biggest pieces of that is depreciation. So you are offering depreciation in this fund. So that's huge. So what I'm hearing is you've got the triple net lease that protects against all the moving variables that, landlords are struggling with on a day-to-day basis. You're going in with higher quality tenants that are there for the long term, talking 20, 30 years, decades at a time with high-ranking corporations like Starbucks, Arby's, McDonald's, things like that, and you're able to do this on a passive level where you're getting all the depreciation and the cash flow without having to put in the work within this fund. I love it. So let's talk about how people, one, let's get into a little bit of depth on this fund. And for those people that are looking for this type of consistent cash flow with depreciation, with higher quality tenant base over a longer period of time, can you show us what all they need to know as far as how this fund can apply to them in their portfolio?
Yeah, so we've got different investment classes depending on the amount investing, but it's a real simple process. We've got an investor portal set up. You log in, you can see the options available, go through all of the details of the fund, all the legal paperwork and stuff like
All
that.
the fun stuff, right?
And yeah, and then once you invest, it's quarterly distribution. The one thing I will say is like after you're invested, it's very passive even for the investor and for me as the operator because there's not a lot of updates. And so it's not very sexy when it's like, okay, well, Starbucks is still selling coffee. That's the update, right?
Yeah.
Like because it's so predictable, there's not like all these moving parts. Like if you're doing a ground up development, it's like, oh, now we've got the footings poured and now, we're starting to we put on the roof and we got shingles today and like all
Yeah.
these things that are all these moving parts. And so there's very few moving parts. It's really just like, hey, everything's still operating as planned. Starbucks is still selling coffee, and McDonald's is still flipping burgers, and they're all still paying
There's
rent.
your update, everybody.
And, yeah, and they're still paying rent. So there's not a lot of updates when it comes to changes. It's basically, hey, we're running this according to plan. Here's a property we just acquired, and here's the next one we're looking at. Um, and so it's very easy once we get set up and get going. Um, and a lot of times most of our investors are repeat investors, so they're basically coming to us, they hit a bonus or they sell something else and like, all right, we've got to take an existing property. It's a big headache for us. Maybe it's a single family rental or multifamily. Like we're going to sell that and invest the profits from that into the fund and go from active to passive on the investment side of things.
Absolutely. So are you guys accepting 1031 exchanges?
We can accept a 1031 exchange, but with the depreciation that you're getting in year one, you're able to offset a lot of the capital gains without it being tied, to that 1031 exchange.
Yeah, that makes sense. And I think a lot of people who 1031s are great. There's no good or bad tool, but I think depending on where you are in your investment career, again, that's a conversation for a different day. But I thought I'd
Yeah.
ask. So what for investors, they're listening to this, they're like, okay, this sounds pretty great. Uh, who is your ideal investor? Who is it that what you guys offer and the types of deals that you go into? who is the ideal target person that you're saying, okay, listen up, everybody. If you fall into this, or this category, you need to be paying attention to this deal.
Yeah, I would say our primary investors are high income earners looking for that tax write-off.
Mm,
So we've got, with these properties, we got a lot of bonus depreciation and accelerate depreciation that we're
love it.
able to bump up in the first couple years. So anyone's got a tax problem, this investment works out really well for high earners, everything from professionals uh, doctors, all the way to owners or people who've just had an exit of a business and they're looking to place some capital
Yeah.
and go passive and, just something that's passive and stable while getting that benefit of the depreciation and offset taxes.
Absolutely. I think you nailed it right on the head as they understand the power of cash flow, especially a business owner who, you've put your entire life into this baby and once you sell it, you get this lump sum of money. And I think we've all started to realize that lump sums of money mean virtually not nothing, but a lot less than consistent regular cash flow. We don't want money, we want cash flow. And so for people who are looking for a way to recreate an income stream, that could be that these types of triple net leases could really be powerful, especially if you're a passive investor and you just have to give the money away and let everybody else do the work. Why not? Um, so when you're talking with, I know you've got high net worth investors. This is a group that, like you said, they're looking for a way to increase or maintain cash flow while they're either stepping away from their business or from their career and they're trying to take more time for themselves. I think they seem to understand this model better than newer investors. Um, when you're having conversations with high net worth or wealthy investors, what do you think most of them are saying what are you hearing consistently that they're tired of by the time they find you? They've been trying to invest in other deals. They've been, putting in an effort to recreate this cash flow. What are the struggles that investors have faced before they've come to you and you're able to solve that problem?
I think sometimes they're trying to do it on their own.
Hmm.
And, so typically these properties are going to range between, let's say, $2 million and $4 million. So if you're going to do it on your own, you'd be in for a down payment. Let's say if it's between 20 and 30%, you'd be investing somewhere between 400,000 to $1 million.
Hmm.
Um, and so you're kind of if that's what you have available to invest, you're kind of all in on one property versus when you've got a fund like the one that we've got set up that, three or 400,000 can go towards, a portfolio of 20 properties. So you get that diversification
Yeah.
and you don't have all your eggs in one basket.
I think that's huge. And so for people who aren't familiar with funds, I think more and more in the real estate space specifically, this has become a bigger deal because of what you just said, Tom, is that your money can be stretched further across multiple properties, sometimes even different asset classes, right? Depending on the fund,
Hmm.
your money can go farther and be diversified more than what it is with a single property. And we saw this in the stock market space, right? Like all prior to the mutual fund everybody had to buy individual stocks to build up their portfolio. Well, if you're having to, I mean, if you had to go buy, Apple stock and all these different large and small cap different companies to create a well diversified portfolio, if you had to do that by purchasing individual stocks, it would take so much money. And the everyday average Joe, even wealthy people, investors had a limited portfolio because that's what their money could buy individually. The mutual fund was the first time in the stock market space that the average Joe or people just that wanted to invest in the market could go into the stock market, put their money and buy a proportionate share of each of these stocks and create that diversification. That same principle, and obviously that's worked out really well. I mean, mutual funds are one of the most powerful stock market tools. Not that most of us use them, but the principle of it is incredibly valid and it's being applied to the real estate space now that your money can be stretched out across multiple properties, creating that diversification so you're not having to go out and buy individual properties on your own. I think that's so incredibly valuable. Love it. Now, what does this look like? We've talked about taxes and we've talked about, we just talked a little bit about Wall Street and the stock market world. So people who are already in real estate and business or have Wall Street exposure, how does the triple net fit into an overall wealth strategy, right? Nothing's good or bad. There's a lot of people out there that have their money applied into different assets. How does triple net fit into their overall wealth strategy if they're already in these different sectors of different types of investments?
Yeah, I always look at it as buckets. Like you want
Mm,
it spread between multiple buckets and, diversified in different investments. And you've got some higher risk stuff where, you're going to be getting a higher return or you're shooting for this grand slam. You've got some medium or low risk stuff with lower returns too. So I think you want, and everyone's allocation in those buckets is different depending on your stage in your career
mm,
or your age and time of life and things like that. But I think it's important, especially right now, to talk about there's two things. One, the market, anything in the stock market has been riding a high for a while now, and
yeah.
especially the last 5 years, the gains have been really good. And same with crypto. I'm not an investor in crypto at all, but I know there's been some big gains there as
Oh,
well.
yeah.
Cash money, I'm gonna make it rain.
And so um, with both of those investments, there's got to be a point where you say, you know what, it's been a good ride, but maybe I should pull some chips off the table and put something into some long-term, stable, physical assets that we know are going to be here. So I always say, like, we got to go from digital, numbers on a screen to a physical asset that, I can drive by the Starbucks and I know in the next 5 and 10 years, the building's only going to go up in value because the cost of construction, the cost to hire, the concrete guy and the
Yeah.
electrician and the
Just
plumber
natural
to
appreciation.
build this, it's only going to go up and increase in value. So I know these physical assets are going to hold this value, are going to preserve the wealth
Mm.
and continue to appreciate over time, plus pump off that cash flow that we're looking for on a passive side. So I think as we look at our investment buckets, we say, okay, we've done pretty well with the market, we've done pretty well with crypto. How do we hedge against, you know, take a little bit off the table and say, you know what, we did pretty good. Let's take a little bit and put it over here in this bucket just to make sure we're safe. And I say that because I go back to right before we had our first investment in 2011 when I said I need to get in the real estate game. And that was the primary trigger for that was in 2009. My
Mm.
parents had everything in the market, and I watched their entire net worth and their entire life savings basically get chopped more than in half, like almost go to zero, right?
Ugh.
And I looked at it and I said, that, how can this be? Like, we cannot let this happen again. And so once I started investing in real estate, I brought my parents along and had them investing alongside of me. And we've done very well since then of, not letting all their all their things in one bucket affect their total net worth or, their retirement and things like that. So
Mm.
that's where I look at now and say, wow, if everyone's got everything in one bucket, I go back to 2009, like, don't set yourself up for that chance of having this big nest egg, just get depleted overnight because of something out of our control, some weird government thing. So who knows? Someone sneezes and all of a sudden the valuation of Bitcoin goes down by $10,000. Like it's crazy.
Yep.
So it's like, all right, let's diversify and get some of these buckets, mixed around a little bit.
I love that. I think I mean, you nailed it right on the head. We get so I don't want to say sold, but we see the hype and we see all the fun and we see all the great things that come with, and that's not to say that stock market's not bad, Bitcoin's not bad, crypto, whatever. But when you have everything put into one category, you are so susceptible. You're so vulnerable. And every single asset class, every single investment has a cycle. It's going to go up and it's going to go down. So you have the ability to protect against those downs with, like you said, real estate. But I loved your analogy of getting the chips off the table. So for any of you poker players out there, when you've got those stacks go, I don't know. I know some poker players that are going to go all in. I don't play like that, but I love that analogy, right? When you've already stacked up some chips and you've built some wealth and you've got that momentum, start securing some of that wealth by offloading it and diversifying it into real secure assets that are still going to grow, still going to give you cash flow, still give you the depreciation benefits, but also protect against, all the ups and downs. I always use the analogy of, being in Texas, we talk about football a lot, right? And Super Bowl is coming up soon. So we talk about offense and defense. Your offensive team is going to put points on the board, it's going to score, it's going to do all the fun, sexy stuff. But defense is, I forgot what football coach it was. He said defense is where championships are won, right? If your defense doesn't hold the line and protect all of the points that you put on the board, what's the freaking point, right? So I think that's what you guys are bringing to the table is a strong defensive line, but you're still getting the returns, right? Like it's not a pickle jar in the backyard. So that's awesome. I agree. I love that analogy. So thanks for sharing. Now, let's get into some of the reality and maybe some questions that people who are listening are certainly having. I just mentioned every investment has risk, right? Like that's just one of the parts of the definition of an investment. What are the real risks within triple net, and how are you guys working to mitigate those with the properties and the investments you're going into?
Yeah, so there's always the risk that a tenant could leave. And
Mm.
so one example I'll use is, there's an IHOP in our town that just wasn't getting the sales, and they ended up the franchisee ended up closing down that store. Now we really look at the property and try to minimize that risk and mitigate it as much as we can. And if we look at the core of the location, the amount of traffic, and the building itself, is it somewhat of a square box versus, does it look like a Pizza Hut?
Oh, yeah.
Because
Everyone
then
knows
it's
what a
it's a
Pizza Hut
little
looks
harder to
like.
get somebody else in there, right?
Yeah.
And so there's a number of things when we're doing our due diligence and looking at properties of like, all right, what is plan B? How do we mitigate this? Like worst case scenario, what do we do with this property if the tenant, moves out? We also look, is there personal guarantee with it? Is there
Oh,
franchisee guarantee? Is it a corporate guarantee? Because those are all levels of security as well on the building.
wow. Yeah.
And so I go back to this IHOP, and they had 7 years left on the lease. And so the IHOP is closed, but because it's a corporate guaranteed lease, they're still paying rent. But for seven, they're still contractually obligated to pay rent for the next 7 years. Now, imagine trying to do that with a college student in an apartment, right? Like that's not
Yeah.
happening. And
Oh,
so sometimes you'll drive by a commercial property in your town, and the business might be closed, but that business is still paying rent because they've got a corporate guarantee on there or franchisee
wow.
guarantee on it. And from a large macro perspective on that, it's cheaper for IHOP to pay the rent than to pay their staff and operating costs of running the business. So for
Right.
them, they're kind of, they're chopping it in half and saving some money, but they still understand, all right, we're obligated and we're into it. And we're still, we're trying to just minimize our losses at that point.
Yeah.
Now, in
Usually
that
they're
same
big enough
period
that
of
they have other locations to make up for, I would assume to make up for
yeah,
what
so because it's a
one property
blended,
might be.
it's a blended overhead at that point. Now, from a landlord's perspective, we can start advertising that property either for sale or for lease, and we can try to get another tenant in there essentially to sublease and take over that remaining 7 years, right?
Wow.
So
Okay.
if we get a new tenant in there, and let's say IHOP was paying $7,000 a month, and we get a new tenant that's going to pay 5,000. Now we can go to IHOP and say, listen, we've got a new tenant at 5,000. Will you, since you're still obligated, will you cover the other 2,000? And they may cover the other 2,000, And that way, the new tenant coming in is getting a pretty good deal. They're getting a discounted rate because IHOP still obligated to offset the other part. So it will help you backfill it with a new tenant. Another scenario is uh, you could get a tenant in there that's paying more than what IHOP was. So they might be
Ooh.
paying $10,000 a month. And at which case, um, or you could sell the property. And so there's two scenarios. If you find a tenant at the same rate or higher, or even less, or you sell the property, once you have that kind of secured and you know that it's going to happen, you can then go back to IHOP and say, listen, um, we're willing to let you out of the obligation for the next 7 years. The total amount that you would owe us is, and whatever that number is, so let's say it's 1.5 million, you could say, all right, instead of you paying that out over the next 7 years, we'll let you off the hook for $1 million. And so you're giving them a discount of 500,000. You're collecting the $1 million from them. And you're also either selling the building or leasing it to a new tenant who's going to be paying the rent. So it's almost like getting double rent.
Oh my God. So like this worst case scenario of them moving out could potentially be a massive money move. Like that's
Yeah. And so
insane.
we've done that. We've seen it done with other, landlords. And
Oh my God.
there's no other asset class that you can do that with.
No freaking way. Like that blows my, but yeah, I mean, you're basically saying, hey, here's the present value of all the money you would pay over the next 7 years. Just, oh, wow. That's
Yep.
huge. So there's obviously a way to mitigate the risk. Obviously, people, companies can move, and all of us have driven by different abandoned buildings and things like that. But I think, like you said, there's certain ways to, and I saw, it's so funny, I saw a meme the other day, and it was a picture of an old Pizza Hut, and somebody commented, no matter what business goes there, we all know it used to be a Pizza Hut. So obviously, we want to be careful about what buildings you're buying, but there's a way to mitigate that by either getting those corporate guarantees and or letting somebody buy out of essentially buy out of their lease when they're no longer in the property.
Yep.
That's so what about what about if we are obviously again we just talked about what we've seen in the market economically and all of the cycles that go with that. There might be times where the tenant doesn't necessarily shut the doors, but there is an economic downturn. Is there a way to stress test the triple net deals for economic downturns when these businesses in there might be, you know, struggling?
Um, so it's the leases and typically the leases and the rate that we have, that we borrowed for it are locked in for such a long term that, it goes through those ups and downs, so like Starbucks, for instance, we have 5 years left on the note to the bank, and we've got 5 years left on the lease. So like if they're struggling this year, we've still got another 4 years on both of those things. Now, we have had tenants come to us and say, listen, it was a down year. We're struggling to, keep it afloat, or, profitability and stuff like that. And if we could get a break in our rent, that would really help us out right now. And so from a small business owner's mindset, I understand that. I don't want them to go
Of
out of
course.
business. I don't want to have to find another tenant. So we're willing to work with tenants to make it work on both sides, because I know the ups and downs of it. And I know if we can get them through a down year or down 2 years, and if that enables them to be with us for the next 10 or 15 years or beyond, then we're willing to work with them and do that. So how that looks from a landlord and a lease perspective is, if let's just say, for instance, if it was Starbucks right now, I would say, okay, well, what do you need to discount the rate to in 2026 to make it work? And then I would say, okay, well, we can do that this year. Next year, we're back to the regular rate. But in consideration for us giving you that discount off of this year's rent, we're going to need to add 2 more years onto the back end of the lease.
Oh,
And so we'll
okay.
make up that cash flow, that cash shortage here in this present year, but we've got the extra 2 years where we'll also have some rent bumps as well. So we look at it and say, all right, we will get that back. on the back end with a higher lease rate plus a longer lease term. And that way it works out for both of us.
That okay, so you guys really are playing the long game, right? Like this is not a I know a lot of people, again, multifamily has been one of the biggest areas of commercial real estate. And from like 2013 to 2020, 2022 was a really that was the gravy train, right?
Hmm.
And that's great and wonderful. But I think we started to see 2019, 2020, there was this, and even into 21, there was this I mean, crazy run of people buying properties, flipping them within a year, 2 years, 3 years max, doubling their money. And then all of a sudden, like, this is the silver bullet to solve all your money problems, right? And what we have started, well, we've come to realize is that was such a short term phenomenon that occurred, it's not a realistic wealth building plan. And so for you guys, you're playing the long game and you're looking at this not on a 1, 2, or 3 year scale. You're looking at this for literally decades. And me personally, I love that because when I get cash flow, I want it to last as long as possible, right? Like I don't want to have to go find a new deal in 2 or 3 or 5 years and have to go vet a new sponsor or vet a new property. Like once I find it, if I can put my money somewhere and just collect a check for the next, 7, 8, 10 years, okay. Right? Like I can't think of anything better. So that's fantastic. Um, did you have any visuals or anything that you wanted to show potential investors so they could start to get some grasp on what this looks like in the Tom Rowan team?
Yeah, I can go through a few things here to kind of visually just show you like, all right, what's the system look like
Yeah.
and how does something like this
Let's get a
work?
behind the scenes curtain pull.
All right, so some of this stuff, we've talked about before, but one of my big aha moments on the triple net lease, um, somebody asked me who owns the post office, and my initial reaction was, well, I think the U.S. government does, right?
That would be
And they're
my thought.
like,
Yeah.
no, they don't. They don't own any of their real estate. And so I looked it up. This is our post office in small town of Farley, Iowa, with population 1,000 people. And I did a little search, and I realized this farmer down the road owned the post office, and they had a 50-year lease with him. And I was like, wait a minute. We got people that are buying houses and apartments and signing, a 6 month lease or month-to-month lease. And this guy's been collecting rent for 50 years. That is amazing. So I was like, how crazy is
Wow.
that you could own the post office and you're getting that for 50 years?
Yeah, that's an eye opener. I think that would shift my perspective a little bit.
And so then, I watched the movie The Founder, and I talked about that with McDonald's model. And it was that same thing. It was like, wait a minute. That's how McDonald's, the famous quote was like, we're not in the burger business, we're in the real estate
Love
business.
it. Yes.
And now McDonald's actually only owns about 40% of their real estate, and the other 60% is owned by investors like us. And, because they've shifted that model a little bit where they still own some, but they're able to do a sale leaseback, which means, if they're selling it and they're doing it at, let's say, a 5% cap rate. So um, that money, that equity on their balance sheet would be a 5% return. Well, they know the operations from the company, if that's getting a 15 or 20% return, then instead of having this real estate on their balance sheet, they could use the money and capitalize by opening up more stores. And this model's been repeated by Starbucks and Dutch Brothers and Scooters Coffee and all these coffee shops. And that's where you see this massive explosion of fast food restaurants and different chains is they're
Oh.
building the stores, they're doing long-term sale leasebacks, and then they're taking the capital from selling the real estate and doing that to launch the startup of a new location. And so that's how a lot of them are really funding this. And it's a win-win for both sides because the corporation doesn't have these assets sitting on the balance sheet. They're able to expand. And from an investor's point of view, We've got great national tenants who are strong. The more locations they open up, the stronger they get and the bigger the brand becomes,
Yeah.
and the more valuable that real estate is over time. So it really is a system that works out very well.
That's fantastic. And shameless
So
plug about McDonald's. I think you and I talked about this, that Ray Kroc, he actually used his infinite banking policy to buy out the McDonald's brothers and launch the marketing for the entire McDonald's franchise. So, fun fact about that.
yes, no, it's amazing. And so here's what this looks like. You drive down the street and you see all these commercial properties, and you just assume that they all own these internally. And the reality is these are all owned by investors
Wow.
like us and with long-term leases. The thing is, you'll never see a for sale sign in front of these properties. They're typically traded. We build relationships with the current landlords, so they're not even getting to a real estate broker. They're just going from landlord to landlord.
Wow.
In some cases, they are listed with a commercial real estate broker, but again, these listings are not on your local MLS with, single family house and stuff like that. There's a couple specific real estate websites for commercial properties like these and specific brokers. So a residential broker is not the same as a commercial
Mm.
broker on these as well. Um, how do we find these deals? Again, a lot, we're pinpointing the best locations, the parking lots that are full, the places that have drive-through lines that are completely packed. We're not trying to develop something new. We're looking at stuff that's already tried and true, businesses that have been established, that have been there for a long time, and that we know are standing the test of time. They've got five-star Google reviews. They've got good management in
Hmm.
place. They've got good workers in place. They're surrounded by a high density of population and high traffic streets. So we know that they're always going to get that traffic. So we're looking to lower our risk as much as possible by just finding these tried and true places that are already successful. They've been successful for the last 20 years because we know then they're going to be here and successful for the next 20 years.
Yeah, you're going into that proven model, right? Not having to recreate the wheel.
Yep. And so there's three different paths like people do. You can either own them on your own, which I said, requires just a large down payment. Or you could partner, JV partner. So that's finding an expert in this asset class. And maybe you've got a lot of money, you just want to do a 50-50 deal with them. Or you could be a limited partner and invest into a syndication or a fund like the Bankston Wealth Fund that we have open now. And that's on the completely passive side of it. So here's here's our investment focus. It's, you know, investing in income producing properties that exhibit strong real estate fundamentals, high quality tenants, industry leading tenants, prime locations. Again, this is just as much about passive income as it is about wealth preservation.
Love it.
We really look at that long term. We look at the long game, and when we're looking at the long game, that's where that wealth preservation comes in. It's like, all right, does this property stand the test of time, and will it continue to appreciate in value, continue to pump off cash flow, and just continue to be stable and protect our investment.
Love it.
So here's a mix of, some of the tenants. Again, I went through a lot of national tenants
Few of these look
in there.
familiar, I think.
Yeah, it's fun getting checks from them, and it's also fun to support these tenants and be able to write that off on taxes as well.
Yeah, no kidding. Oh my gosh. So
So
you're
if you're
writing off
not
being able to support them, and then you're purchasing from the companies that you have in place and just writing it off.
Yeah, so it's like, all right, I'm gonna take my kids to Village Inn for breakfast. And it's like, all right, if I can write that breakfast off because they're a tenant of ours, that's a win-win for
I
me.
love that. I didn't even think about it. Oh my gosh, that's fantastic.
So what's this if you're not familiar with the syndication or fund, like what's that look like? So the deal sponsor, the person, the expert in this is also called the syndicator or the general partner. They're the person that's finding and sourcing the deal. They're doing all the underwriting. They're putting together the plan. raising the capital, operating the day-to-day, managing tenants and leases. They're lining up the banks for financing, and they're handling all the other investor relations stuff. And from an investor side, so the investors are limited partners, and that's the passive side of the business. And really, the investor, they're only responsible for placing capital in the deal. So that's how the two sides of a real estate syndication or fund work. And the benefits, again, you're getting your foot in the door and access to bigger and better opportunities with a smaller investment. As low as $50,000 is our minimum investment versus having to come up with millions to get in this asset class. You're able to spread that investment across multiple deals. You can lean on someone else's expertise to do all the due diligence, the research, analysis, create the relationships with the banks and the landlords, and find these types of properties. Again, you don't have to develop those relationships. You just rely on the operator to do all that.
Yeah.
We use having a $100 million portfolio gives us a really good balance sheet. So we get favorable financing,
The banks probably like you guys.
yeah, versus someone going in for their first property, because we're able to, they're able to look at that diversification of the whole portfolio, not just a property on its own island. And we're able to find deals that, are never available to the public. We've got people reaching out to us constantly, with these opportunities. And the more we grow, the more deals that we find, coming our way. And it's hands-free and completely passive for the LP investors.
That's the best part.
And we get consistent cash flow, tax savings through the depreciation,
I
and
guess I lied. That's the best
diversification.
part.
Yes,
I like
and
the cash. Yeah.
diversification. So again, passive income without oversight managing, watching the stock market, without worrying about the tenants, without wild swings in the market.
And you're
You
not
know,
having to move your money every couple of years because, again, you guys are in it for the long game. So you're not having to go vet new deals every couple of years when, this property sells or that property sells.
yeah, we just like to keep it simple. And again, just simple and predictable is where we like to be. So how we do this is, so the four components that kind of compound with each other is that combination of cash flow, appreciation over time, the tax benefits, and then the debt pay down over time as well. So all those together, create these great earnings on the asset, on the portfolio, and with the fund. And so typically, what this looks like is the partners are getting an 8 to 12% preferred return.
Nice.
Then after that, we don't collect any sort of split on the waterfall until all the LP investors get 100% of their money back. So a lot of these funds will start the split, whatever that range is, after the preferred return. And ours is set up, it's called the European style, but it's set up with the investor in mind of, all right, we're going to pay out the preferred return, then we're going to pay investors back 100% of their capital before we take a split. And after that, it's a 70-30% split, with 70 going to investors. And from there, also, we're participating right alongside investors. In this current fund, we'll be putting somewhere between $500,000 and $1 million into the fund, just to show that we're aligned. We want this thing to perform, and we want to be part of the action too. So,
You're putting your money where your mouth is. Obviously, you guys believe in this
yes,
deal if you're putting your own money into it, which is always a big question investors should be asking their operators, right? Are you investing in this deal?
yep. And then the bonus depreciation with cost segregation. This number in percentage could vary depending on the properties that we buy, but you're going to want to talk to your tax accountant professional about this. But this asset class favors very heavily for accelerate depreciation
Okay.
and being able to bump this up and defer as much taxes as possible with it. So you'll be part of a K1 paper loss. And, if someone's got a tax problem, commercial real estate definitely helps
Oh, yeah.
offset that.
And bonus depreciation back is back at 100% now. So this is the time to capitalize.
Yep. So some people say, like, what about the news? Have you heard the commercial real estate is in a meltdown, right? And so I pulled these news articles, and pretty much any day of the week, you could probably Google this and see some sort of headline, right?
Oh, yeah.
And a lot of it is what I would call clickbait headlines, because when you say commercial real estate involves everything from multifamily apartments, office buildings, industrial properties, retail, commercial real estate, and everything else in between, basically anywhere that's not a single family house.
Yeah.
And so when you see these headlines, the other thing that's misleading is, um, you know, is commercial real estate facing meltdown right now? Well, it depends. What are you referring to? Are you referring to office buildings in San Francisco, or are you referring to a McDonald's or a Starbucks in the middle of Iowa?
Right.
Right? Like there's completely different things here. So a lot of this clickbait is, you know, small sectors. It may be a particular asset class, which is office space, has obviously taken a hit
Oh, yeah.
in larger commercial areas. But we're not investing in office space. We're not investing in big metropolitan areas. We like tertiary markets where we know the need for these retail specific tenants is part of their community. It's part of they've been there for a long time, and they're somewhat recession resistant because the population density surrounding these small pockets of retail areas and smaller communities is they're there. I mean, it's a small town support, and
Right.
there's not a lot of other options for them to do these kind of regular places. So when you see this headline, it's like, well, yeah, office in New York and San Francisco and some other big cities are hurting, but that's not all commercial
So
real
you're
estate.
saying that we can't believe everything we see on the internet? Oh my
No,
goodness.
and of course, then they throw like Elon Musk photo on there because we got to be able to click on
Oh
it.
yeah, we got to get that clickbait.
Ross Perot Jr. on Shark Tank. So it's like you notice they always like have somebody else tagged in there just to get that extra click in there as
Uh-huh.
well. Um, and then just showing like how this compares. Like I like to compare, so we call this the fast food landlord model compared to traditional multifamily, like credit rated tenants with predictable cash flow, no management of people, repairs, trash, mowing, snow. It's completely passive, high traffic locations, highly sought after. We just purchased a property in July, and the tenant is AT&T.
Oh,
It's great. Yeah, and I'm like, okay, this is a new tenant, and we love having AT&T as a tenant. They have 2 years left on the lease. Since July, we've had two other tenants call us, two national brands. I can't say their names because of confidentiality, but two other brands have called us and said, listen, we want to buy out their lease, or if they don't renew, we want to move in that space and we're willing to pay more than what their current lease rate is.
oh,
So we basically have a waiting list on that property. And so, you don't see that too often in other asset classes either, where
no.
someone's not only willing to be on a waiting list, but offering to pay more than the current tenant is paying. And I'm
Can you
like, so
imagine a tenant coming into your apartment and being like, "Hey, Joe Schmo that lives in 8B, I want to buy him out, and I'm going to pay more than him just because screw that guy," right? Like,
I know. And so after
that's
we got that
hilarious.
property, I was like, oh my God, I'm like, we definitely got the right property here. Like this is in the right location and it's the right building because we've already got other tenants reaching out wanting that specific location.
I love it.
And then that long-term guaranteed leases. I mean, I could not imagine having a 6 month lease or month to month lease. Having these 10 to 25 year leases, it is just like it creates so much peace for our strategy and our long-term investing, like what we're doing. And that's where you said, like, yeah, we play the long game because that's how we're always looking at it with these leases. And some of these leases, I looked at yesterday a couple that were 20 years, and I'm thinking to myself, all right, my birthday's coming up. What am I going to be doing in 20 years when this lease ends?
Oh my
And I'm
gosh.
gonna be like, man, I'm gonna be in my 60s then. And I'm thinking like, all right, how old are my kids gonna be when this lease ends? So when I see these leases that extend to, you know, 2035 or 2040 and beyond,
Wow.
it's like, oh my gosh, this is wild. Like I can think back, all right, what was I doing 10 or 15 or 20 years ago? And then I think, holy crap, if I owned that property 15 years ago and they had a 15-year lease, now if I owned it and it's another 15 years forward, what does life look like then? And so it creates just such a different mindset and different mentality in investing when you have this long-term horizon of these leases.
Yeah, that's just unheard of.
And so then, what you want to ask yourself as an investor is like, all right, how much do you have to invest annually? How much passive income do you want to make monthly or annually? And what's your timeline look like? And then how much income tax are you currently paying? So like if you
Ooh.
can take these numbers and start writing this down, you can reverse engineer what it looks like. And this is where, we go back from the very beginning of the self-discipline
Mm.
and to be able to get in the game and then to get in consistently. So I've taken our investors and I ask these four questions first. And I say, all right, well, to achieve this, to get to your end goal, it's going to take you 3 years or it's going to take you 5 years, and here's how much you have to invest annually to get there. Or if we want to shorten the timeline, you've got to invest more. If you don't have the capital that much to invest, then the timeline might be a little bit longer, but it gives them a sense of like, all right, where's the goal? Where do we want to get? What do we have? What are the tools and resources we're working with right now? And then how can we reverse engineer and close the gap and get to that finish line? And for some, they realize, okay, we've got to, make some adjustments on our lifestyle or our spending to be able to invest more to get us to retirement or to, in some cases, people say, well, our goal is this much a month because we want our spouse to be able to quit their job,
Yeah.
right? So we're trying to replace that. And so, it's just a little financial engineering here of figuring these four questions out. And then that helps them understand, all right, here's the goal for investing. Here's what we got to do
Yeah.
this year. Here's what we got to do next year. Here's what we got to do year after. And again, it comes back to that consistency and that self-discipline. And it's not a get rich quick overnight thing. Again, we're playing the long game here, but once it's in and it's a set it and forget it, it starts compounding. You're able to, start building that up, and all of a sudden, over 3, 4, 5 years, you're building up not only a higher net worth, but your passive income grows at the same time.
And I love that you're giving them like a definitive measure, right? Like, hey, if this is what you want to accomplish, let's create a concrete roadmap of what it's going to take to get there. And like you said, reverse engineer. And I think that's what so many people, specifically investors, are lacking is what's the end goal? What do you want to accomplish so that you know what to do in order to achieve that? So going through that with your investors is huge. I love it.
Yeah, and traditionally, if we think about a traditional W-2 job, we're putting money into a 401(k) or something like that. And the horizon is so long before you see anything because, you're not pulling it out or getting paid from it until you're 65, right?
Right.
And so you don't get this feeling of that because you're not getting these quarterly distributions or the monthly distributions coming from it as it continues to grow in the background. And the same thing works, with the whole life plans and the infinite banking is you can take the same concept and say, all right, well, how do we arbitrage the return on the investment? So if we're able to, borrow the money out at a certain percentage and we know we're getting an 8 or 10 or 12% return, we're able to arbitrage that and make that money in between it and really start making our money work for us even better.
Yeah. And all while your money continues to grow in your policy while it's getting this return.
Yes,
Tom, you had a
100%.
really good teacher on infinite banking. You seem to have a good handle on
Well,
that.
we're in it and we're doing, we practice what we preach. And, it's like I said, it's all part of it. It's getting in the game, it's being consistent. And we know it's not an overnight thing. We look long term and it's just consistency over that long period of time.
Yep, and I think too, the getting in the game part is underappreciated because it's so easy to look at all of this and kind of feel like you're drinking from a fire hydrant, right? Like it's new and you're kind of figuring it out. And like you said, it's easy to read books, go to the conferences, and do all the things, right? Watch all the YouTube videos, and that's fine. But between you and I mean, I've done a lot of different interviews with folks, and everybody says the same thing. At some point, you have to get in. At some point you have to don't give yourself paralysis by analysis, nitpicking everything. When you go buy a car, yes, you want to do your research. Yes, you want to look at it. Yes, you want to decide the features and what you're willing to pay for and the brand and the warranty, whatever. But do you need to know like how to build an engine before you buy the car? No, you need to understand the features that matter and all the different factors that are going to impact you. You don't need like an engineering degree or, again, be a mechanic to be able to buy the vehicle. And I think that's where so many investors get stuck is they're getting stuck in the weeds and they're reading every little, and I'm not, again, read your contracts and do all the due diligence, but don't get stuck in the weeds where you don't even move forward because again, you're trying to build an engine when you should just be buying the freaking car, right? Like, so I agree. The consistency is key, but you can't be consistent until you get started. So, what is for people that are like, all right, I see it, I get it, I understand the value, but I want to learn a little bit more, or I want to get in touch with Tom or anybody at Bankston Wealth. What's the best way for them to get connected with you, learn more, and just dive deeper into this triple net model?
Yeah, the easiest way is just go to bankstonwealth.com and hit the interest button and you fill out a quick form and just shows and I'm happy to jump on a one-on-one call with anyone
Love it.
and talk you through like, hey, here's the opportunities that we have available. And again, we go back to those four questions. Where are you at right now? Where do you want to go? And how can we help you achieve your investing goals with that?
Love it. I think that'd be really valuable for people, especially again, high net worth people that are looking for the tax breaks and want to increase their cash flow. I'm thinking about my kid going to college in a few years, right? Being able to increase income to cover upcoming expenses. There's a lot of different reasons. Or if you just want more money in the future. I don't know. Sometimes that sounds nice. That is, Tom, thank you so much. This has been eye-opening. And again, I know you and I've talked so many times, but to be able to dive into the details is just like mind blowing. Thank you so much for sharing. So let's wrap up. I want to make sure we kind of come back to the specialty of this, which is Tom Rowan specifically. Again, like you said, you've talked about getting in the game, being consistent, and being disciplined, all of which is apparent in every aspect of your life. Is there a specific mantra or quote that you really find value in or that has played a big part of your life?
I as a runner, uh, I I always keep saying, keep going. Keep going. You've got this. Keep going and you've got this are, two things I say to other people a lot. And I also repeat them to myself a lot because it's just that reassurance that, you just got to keep going and you've got this. And it just it keeps reinforcing that. Um, and besides that, like I'm a big fan of manifestation,
Mm.
Napoleon Hill, Think and Grow Rich.
Yes.
And but again, we've talked about this and we'll say it again. You can read the book, you can try to manifest all you want, but none of it happens without action. And so you actually have to take action and do it. And the other part that I find with whether it's investors or friends and family or whoever else is the biggest the biggest roadblock from action is fear.
Ooh.
And there's two fears. It's a fear of failure and it's a fear of what other people are going to think. Um, And so once you eliminate the fear of what other people think, that opens up a lot of doors for you. And the biggest thing is when I think of the fear of what other people are going to think, realize they're probably not thinking about you anyways, because they're probably just thinking about themselves. And so, and if they are, who cares? Like, whatever, they can think whatever they want. That shouldn't affect what you're going to do because like you're on this path, you're trying to get to, what your purpose and your goal is and everything else. That what other people think doesn't matter. Like you're playing your own game and you got to get to the finish line no matter what they're thinking about. And just the fear of failure is like there's no to me there's no such thing as failing. Like that first property I had, some people would be like, holy crap, that was a big failure. You had the worst tenants possible. You had to deal with like all this stuff. And to me, it was like, no, that was the biggest learning lesson. And it was this thing in disguise that steered us toward the right asset class to put us on the path we're at now. So when you get in the game, something might appear to be a failure, but really it's just a nudge to saying, well, you've got to change directions or you've got to go down a different way, or this was a learning experience. Take from it, build upon it, and keep going. And keep going beyond that.
I love that. And I've always heard, fail, FAIL, stands for first attempt in learning. So just like you said, right?
Hmm.
Like things are going to happen. It's what you do from those experiences that matters.
Yes.
That's so powerful. Thank you, Tom, so much for sharing all of this and diving into your story and just spreading your wisdom. Obviously, you've done so much in the different areas of real estate and business. Um, so I mean, we could go into even more detail about your savvy and your wisdom and all the different uh, advice you have. So I appreciate you coming on, sharing this. And for those investors that are looking for long-term cash flow, with upfront depreciation and tax benefits in a area that has removed essentially every variable that I can think of in the world of real estate. But make sure you reach out to Tom and his team. Click that interest button so you guys can. I mean, he's willing to do a one-on-one, y'all. Like this guy who has $100 million in assets and is building this incredible fast food landlord model is willing to have a one-on-one with you as an investor. So don't miss out on this opportunity. Take advantage of it. Again, Tom, thank you so much for coming on. And you guys, if you have not already, I don't know why not, hit the subscribe button, hit the like button so you can continue to meet as many people as you can like Tom that are out there. Again, this is Real Money Talk where real people are making real money so you can too. Until next time, keep it real. At Infinity Investment Strategies, we teach investors and business owners how to become the bank. In using the infinite banking strategy, you can lower your taxes, increase the control you have over your own money, lower your risk against multiple wealth eroding factors by adding additional layers of asset protection, and increase your leverage with guaranteed growth and the opportunity for dual rates of return. With authorized infinite banking practitioners with experience in business and investments, we are here to help enhance your portfolio.